Much, Megan. Good afternoon or good morning, everybody, depending on where you are. Very happy that you've joined us today for what's going to be kind of an overview session. We're not going to dive into tons of details on this, but we will be doing that in the days to come, taking sections of each of this and really breaking it down for you. But today we want to focus on just an overview of both what's new and what's changed and what's still the same in the Paycheck Protection Program with the second draw now available. And also dive into something an awful lot of people don't know a whole lot about, which is the Employee Retention Credit. So we'll take PPP first, the ERC second. Just by way of introduction, my name is John Sweisberger. I'm the partner in charge of Armanino's Business Outsourcing Services practice, and I'm joined today by the lovely and talented Jen McCabe, who is my partner in crime. And we have been living the PPP and ERC dream now for 9.5 months, and hopefully can get as many of your questions answered as possible as we go through this today. So our plan for today is kind of start with a few lessons learned from what we are calling PPP 1.0. And then dive into what are all the new things around the PPP program with both first draw, as they're called, and second draw loans. And then spend the second part of our session today really diving in on the employee retention credit, which if you do not know about that, definitely have your ears perked up, because for some, maybe many of you, this could be extraordinarily lucrative. So let's dive in on the first part, and that is going to be sort of some of the lessons that we've learned as we've gone through the last 9 months with the PPP program. And let's start on kind of the notion that lenders matter, right? We have heard so many horror stories of borrowers that couldn't get a loan through their banker, even though they've been with them for 3 decades, finally got a loan, can't get any answers from the lender, can't still get in to do forgiveness and things like that, which just frankly, they're abhorrent to us. We've been processing forgiveness applications for 6 months effective today. We literally started doing forgiveness apps for banks on July 15th and had them ready to go in August when the SBA opened up the portal. The fact that there are still a bunch of lenders that are holding back on forgiveness is just frankly not right in our book. So make sure you're picking your lender very carefully as you go towards possibly either your first or a second draw loan. But understand a couple of things. Banks are using different technologies. Banks' understanding of the rules are all over the map. We've had to go to the mat, literally getting the SBA to send us answers in writing that we already knew the answer to, but the bank didn't want to hear it from us, to prove to the bank that they were handling a client wrong. So just know that banks are all over the map on this. And what's really going to be important as you go through this and you're searching for a lender in your process for either a first or second draw loan here over the next couple of months, make sure that the lender you're talking to not only is good with customer service, but really is comfortable and understanding of dealing with the SBA, has avenues and channels to the SBA, and a track record of working with them. There were so many banks that we heard about that just jumped in that didn't really know what the SBA was all about. And that's where an awful lot of problems have been. So that's kind of a big take on lenders from our side. But what I wanted to do here, and I thought would be really valuable, would be to bring in a lender to provide their perspective on some of the best practices that they've seen and or lessons that they've learned. And so I've invited Luke LaHaye to come in. Luke is the founder and chief investment officer for ACAP Group in Chicago, who's partnered with the Loan Source, and they're handling billions of dollars of loans that were originated by other banks. So Luke, tell us a little bit about what you've seen in your process over the last 6 or 8 months in dealing with forgiveness with lenders, or with
Yeah,
borrowers.
yeah. Thanks for the intro, John, and thanks for having me. Happy to kind of give a lender's perspective. I know a lot of you borrowers probably are, have varying levels of frustration with all the different components of the PPP process. One thing I definitely will point out, it is a tough process, and it is from the lender side too. And everyone, even if you're, your institution, you may feel they don't give you enough information, or they're not doing a good enough job. I'm sure they're working very hard to do it, and I can appreciate, probably a lot of the pain that they're going through of just technology, implementation of customer service, and being able to answer, very detailed technical questions. So, I guess maybe my first thing would be, just be patient with the lender, because everyone, is working really hard and trying to get out some good service and technologies, but it's not flawless, right? Because this is the first time anyone's ever done this. So, some of the, John asked me to join today, and I thought I'd just put, kind of 5 maybe tips for this next round together that might be helpful for, for the borrowers as they go into whoever their lending institution is, whether it's a bank, or a non-bank like someone like us. A lot of time has been spent in institutions on the portals, and there's a lot of helpful instructions in there. And the easiest way to get through the application, quickly and accurately, is to really just take your time and go through the portal, read the help tips, follow those, rather than try to click through really fast and try to call customer service, because that does create a lot of bandwidth problems for the lenders. So you'll find that you'll move very slowly if you do it that way. So if you follow the instructions in the portal that are usually very detailed, that's going to be your best, kind of best and fastest way in. There are required documents, even though everyone would, like to think there's not, or maybe, like to say that they don't have to provide them. If the lender's asking for them, you just do need to provide it rather than try to resist and fight it. They're really trying to get the right information to be able to make the proper loan and follow the rules and guidance. So, just providing the requested information is key. A lot of times, third one is like we try to communicate with a lot of our borrowers to, come submit forgiveness. So like John and his team, we've been processing forgiveness applications for our 35,000 borrowers since August. And there's probably 70% of people haven't even started, and maybe half of them haven't even opened emails from us. So we're not sure what they're doing. So you just be on the lookout for the emails, make sure you set up your accounts. That way you can, get the actual communication from your lender. When you're going through the second round, this might seem like a little thing, but from the lender side, it actually is a big pain point, is when you're inputting your ACH information, or pulling your check, like quadruple check it to make sure it's right, because there's nothing worse than you get all the way to the end of the process and there's something wrong with the ACH information, and then it kicks off an entire manual process at the lender that takes literally days, because there's not just one loan. I mean, could be 10, 100, 1,000, right? So the problem kind of compounds. So just make sure that information's right, because I've seen that slow people down a lot. And obviously these loans are very important to get out quickly. So providing the accurate information there is key. And then the first draw of payroll information. So, one of the rules for under 150 is if you're going back to the same lender, you might not be required to provide that payroll information again. We've had a lot of different, lender forums, with lenders all across the country, varying sizes. And generally people are probably going to require that you provide that information again. And it's not because they can't go look for it. It's because it's not efficient to have a different team member go look for it. There's also 3 or 4 different times, if you remember, during the first go around where the rules changed and then payroll reports changed. And so it actually is faster, regardless of which lender you're going to. Just get the new payroll report for the period and upload it with your round 2 loan. Then the lender doesn't have to go look for it. It's the most current, follows the final rules, and that will get you through quicker, even though you might want to say, no, I gave you that back in April, I shouldn't need it. And then you lose time because you're just not willing to kind of flow into the path of least resistance, I suppose. So those are kind of my lessons learned. And just, I guess I'd go back to, just like be patient. Lenders are trying hard. We have our teams working, 16-hour days, 7 days a week, to get this done. It's not a smooth process. I mean, we're in the middle of rolling out our round 2 platform, and I'd be lying to you if I said it was going, super smooth. There's definitely bumps in the road, but we're all in it together. And when the lenders do want to be here to help small businesses, come back and thrive in America. So I think that's pretty much what I got, John.
Excellent, Luke. Thank you so
what,
much.
Luke, the number one thing you said there that I've, in working with you and all the other banks, is watch for the emails, because even when our clients submit to the portal, the banks are writing back and saying, but I want more, and people think they're done. So communicate.
Yep.
Yeah, the nice thing is when you're getting that communication, you're probably getting emailed from the person working your loan file. So if you respond very quickly, they can get your application done, and then you're moving along in the process. So that is key, because that's, it's time sensitive at this point.
Yeah.
Thank you
Luke,
all.
thank you so much. Really appreciate you taking a couple of minutes. I know you are just beyond up to your eyeballs, so appreciate it. We'll let you get back to it.
All right.
But thank you so much for sharing that with us.
Thank you. Have a nice day, everyone.
You bet. Okay, so one of the other things that we talked about a lot in the last several months is the whole notion of economic necessity. Remember back in April, the end of April, there was all this hullabaloo about large companies getting PPP loans, and there was this whole notion that if you're over $2 million in your loan, you're going either in one loan or in the aggregate if you had multiple loans. They were going to be essentially auditing for necessity. They've come out with a couple of months ago, Form 3509 for-profit entities and 3510 for nonprofit entities, which are designed to provide the SBA with a bunch of information about the necessity and your situation at the time. There's a lot of challenge and nuance in that. We'll go through that here in just a second. But the basic process that has kind of confused some people is this doesn't get triggered until after your forgiveness application has been submitted. Okay, so once that's been submitted to the SBA, they'll trigger the lender to say, you need to go get a Form 3509 or a Form 3510 from your borrower. Once the bank notifies you of that request, you only have 10 days in which to respond. So there's a whole bunch of best practices because we've helped a lot of clients around this. Jen, why don't you kind of walk through sort of the basic steps that you want to make sure everybody follows from a best practice standpoint?
Right. So again, this is for people who have more than $2 million. You absolutely have to do this because you will get asked for it 100%. We used to think it was going to be years down the road. We are finding that it is now that you must have it ready. So we're encouraging you to prepare a memo, not just fill out the Form 3509. That's the number one message I have today. The 3509 form, in case I'm talking in code here, is a tax form basically, or a Department of the Treasury form, SBA form that says, how are you doing? How's your business doing? And it's completely unfair because when you applied for the loan, you didn't know how you were going to be doing, and that was the entire point. So the form itself is an open door to more audit questions. The way to avert that problem is to prepare a memo that talks about your business and the liquidity in your business and how COVID-19 adaptation had to happen for your business. So we're having all of our clients who ask for our help do a detailed narrative. And the 3509, talks about the narrative, and the narrative talks about the 3509. The narrative is constructed in the order of the 3509 form, answering all of their questions, but providing the appropriate background information. So if they ask on the 3509, how much money do you have? That's not a very good answer. If I just tell John, I have $100, John wants to know if that's enough. They don't allow you to tell them if it's enough. So that's my great example. The other thing I would say is that when you submit this form to the SBA, you want to submit the form with the memo and with the exhibits. Whoever's reading that form is going to go straight to the memo. We've had good luck with it. The memo has answered all of their questions. If we have submitted only the Form 3509, or if a client comes to us, that we don't let them do that, but if they come to us and say, hey, I sent the 3509, help me answer them because now they're pelting me with additional questions, we are seeing that just isn't an adequate answer. And so they just come back and they ask you for 6 or 7 more things, and they ask you for those things one at a time. So it takes a lot of stress. Do the memo first. Okay, John, you're big on the confidentiality here. You're muted.
And I am, you're right. I am big on this because it's important for you to know that this is all information that they're going to ask around liquidity and capital expenditures and owner distributions and things like that, that is subject to a Freedom of Information Act request unless you mark every line item as confidential information. And in the interest of overkill, I encourage all of our borrowers to also, there's a comment section in each part of this form, to put in there that you are asserting what's known as Exemption 4 of the Freedom of Information Act, which basically says your information is confidential and proprietary and needs to be protected, and therefore not subject to release to any nosy news organization that wants to throw some salacious stuff out there. So that's just a really important way to make sure that you don't get very important confidential information put out into the public eye.
Right. And as I said, it is you have to do it for borrowers over 2 million. Everybody's asking that. Everybody who borrowed actually said that they needed the loan, and there's no promise they won't come back and ask you, except if you have more than 2 million. There's a promise they're going to ask you for it. And I am saying I wouldn't submit the 3509 to them naked. I would send the 3509 well dressed.
Yep, exactly. Just attach it to the form. The other big lesson that's come out, and there was so much back and forth around this, has been the tax implications of all of this. Jen, kind of walk us through what's happened and where we finally landed on this.
Generally speaking, at the federal level, it really is tax-free. There was some confusion about whether they were going to allow deductibility. Now we're past that, and it's not a home-free situation. We have the states listed here, and again, we will send you the slides. The states have come back with mixed answers. Some of the states are including the PPP amount in taxable income, which means that at the state level it's taxable. Other ones are saying we're not going to allow the deduction, which is another way of saying that they're not going to allow it to be tax-free. Okay, so be very smart about this. Ask your tax person for help. We have a link on our website to a constantly updated list of the states and what their rules are. So we'll leave it with that. Just be alert.
Yeah. So basically, as you can see between these two charts, half of the states are making this taxable one side or the other, either as income or no deduction. The other half in DC aren't. So it's very much a mixed bag. And if you operate in a lot of states, this is going to definitely be something you're going to want to make sure that your tax team is all over. Okay, let's jump into this whole new Economic Aid Act then and look at what's changed and what's new and what is still the same. So a couple of quick highlights around the Economic Aid Act as it's being referred to for this portion of the stimulus plan. So open as of this past Monday, so 4 days ago, up through March 31st for new loans. The only lenders able to make those loans initially are small community-based lenders, people with under $1 billion in total assets. The larger banks, which you see at the bottom of the slide here, will begin accepting loan applications next Tuesday. They're open for business, or at least the SBA says they're open for business. As Luke mentioned, they're all working like crazy because this is all brand new stuff to get portal information and everything ready to go so that they can accept the new loan requests. So your bank may or may not be available on January 19th, but if not, will be shortly thereafter. It's important to know that there was a lot of information that came out around what's known as second draw loans, but you can still get first draw loans in this new program if you didn't take a PPP loan originally. And an awful lot of people obviously chose not to for one or any number of reasons. So both first draw and second draw loans are available. We'll highlight the differences here in just a moment. There's a number of other changes that we'll more or less talk through here in the slides to follow, but this is sort of the highlights of it. So let's start first on those loans that people took out in the first go around back in the spring and summer. that have not yet been applied for forgiveness. So these are the existing first draw loans not yet forgiven. You can see a lot of details here, and we intend for this to be a leave behind, so I'm not going to walk through all of the details, but here's the basic highlights of what's changed. Loans that are under $150,000 are now going to have a simpler loan forgiveness application. It's basically going to be a certification. I expect to be much in line with what's currently out there for the under $50,000 loans, which is the Form 3508S. We will know more about that next Wednesday, the SBA's deadline for getting this new form out. So at the moment, we're simply guessing at what that's going to look like, other than it's supposed to be a very simple one-page certification. Another big change is they were originally deducting idle grants that had been made from your forgiveness amount. They will no longer be doing that. They're actually going to be making them real grants and not grants in name only. If you had already gotten forgiveness and they deducted an idle grant or an idle advance, as it's called, you're going to be getting a check directly for that because they've changed the law on that retroactively. They've also done some definitions finally around seasonal employers and look back periods, and they're allowing borrowers now, and this is not an insignificant change, to define your own covered period so long as it's between 8 weeks and 24 weeks. Recall that originally it was either 8 or 24. Now they're saying anywhere in there you can define it, and that has implications for some of the actions that you may have taken that they might look, shall we say, a little bit curiously at. A lot of things, though, have stayed the same in this, but the other thing that's new is some expanded expense categories around supplier costs, operations costs, PPE things that you may have had to do, et cetera. Also expanded the payroll cost. So that's on the existing loans that haven't yet gone through the forgiveness process. As I said, there are now new first draw loans, and that's for people who did not take one out between April 3rd and August 6th, when they had the first draw program open out originally. You can now come back and apply for one of those. It's not gone forever. It's now available through March 31st. The loan application form has changed, so make sure you're getting the right application form. It's available on the Treasury or the SBA websites. I mentioned that the idle advance is no longer being netted against. And this is important. You must not have permanently closed. And that's one of the new certifications. There's several new certifications in here. If you look over at the right, there's some new eligibilities, qualifications. Some new entities are available to, or are now eligible to apply. And there's also now a limit where it used to be a 500 employee limit on any entity. For these new entities, it's a 300 employee limit. Everybody else, if you're not a nonprofit housing co-op, a 501c6, et cetera, you still have that 500 employee limit. But if you're one of those new eligible entities, you have a 300 employee limit. Okay. But the basic rules are still the same. 2.5 times your average monthly payroll cost for 2019. Remember, these are for first draw loans. Rules are different on second draw loans. 500 employee limit, annualized compensation for any employee limited to $100,000. Authorized uses, still the same, but now expanded. And the terms are still the same, 1% interest over a 5-year maturity, with the same basic affiliation rules. So we will be diving in the next week or so to all of these in much more detail. As I said, today we just kind of want to give you an overview and give you some leave behinds. On the second draw loans, and this is obviously brand new stuff, there's much stricter eligibility around these second draw loans than what it was required for either the original first draw loans or the new first draw loans, where you just needed to be able to certify that you have economic uncertainty. In second draw loans, these are available for anybody who had a first draw loan and has used up that money, You can apply for a second draw loan, provided that you had at least a 25% or more decline in your gross receipts in any quarter in 2020 as compared to the same quarter in 2019, or if you don't have quarterly financials, if you can show for your full year of 2020 versus 2019 that your gross receipts dropped by at least 25%, and you have 300 or fewer employees. And employee is the key word here because they go back and forth between employees and FTEs, and they're two different things. In forgiveness, it's about FTEs. In the loan application, it's about noses. How many noses do you have? Whether they're working 2 hours or 42 hours, doesn't matter. They count as an employee. Okay, so here the limit for second draw loans is 300 or fewer employees. Okay, so the only other point that I want to make here is make sure in your loan application that you have the loan number that the SBA issued, not your bank's loan number, but the SBA's loan number from your first draw loan, because that's going to go into the application. Okay. And then finally, as I said, there are some differences between the previous first draw, the new first draw, and these new second draw loans, and kind of laid it out here. The loan amount basis is still 2.5 times unless you are in what's called the industrial classification code of 72, which is primarily hospitality and restaurants. So hotels, restaurants, a lot of franchises and things like that. You get a 3.5 times loan amount rather than a 2.5 times loan amount. The basis that you're looking for in that average monthly payroll cost differs as well between these first draw loans and the second draw loans. For first draw loans, it's simply what was your average in 2019. For second draw loans, you get your choice. What was your average in 2019? What was your average in 2020, or beginning in February, if you apply after February 1st, what was your average in the prior 12 months? So it could be January, February 1st of 20 to January 31st of 21, for example. So that's your choice only on second draw loans, not on first draw loans. I mentioned the employee caps, the eligibility requirements and what have you. There's also a much smaller maximum loan amount available. Basically, you take 1/5 of what the first draw loans were. So where it was a 10 million cap the first time around, now it's a 2 million cap. Okay, so let's hit a couple of frequently asked questions. Jen, you wanna kind of start with kind of what's the covered supplier costs, or you want me to handle that one?
Well, add on, it's stuff that you need to run your business. They are finally admitting that you probably need more than just utilities. They're pretty specific that if it's a supply that you absolutely need to conduct your business. So I talk about it that way, and then when people ask me specific questions, I delve deeper.
Yeah, there needs to be a contract in place before the covered period begins, so before the loan disbursement, unless it's perishable items, and in the case of a restaurant, then it's just ongoing costs for those kinds of things. Jen, this question I've seen in the chat, and we get it a lot. What's the definition of gross receipts on these second draw loans?
So start with, it's the way you do your accounting. So if you're an entity that does accounting and has managerial reports, and you have your quarterlies and you can show year on year, you're going to want to be consistent in the way that you report. They have allowed for people who are unsophisticated, don't have proper accounting, to just provide bank statements though. So for smaller companies, that might be an easier way for you to go. If you are a nonprofit, there's a very specific instruction section. Interestingly, if you're a nonprofit and you sell an asset, you have to include the gross proceeds from the sale. You're not allowed to deduct the cost basis of it. So there's some tweaky things, and it's worth reading the directions, read the form. If you are looking at gross receipts for your company, you do have to include cost of goods sold. You do have to include interest. If you rent or you sublease your space, you have to include that as well. There is a bit of a disclaimer in here that if you're an agent and you actually have contracts in place that show you're an agent, like a real estate agent or an advertising agency, you can exclude pass-through costs that you're just paying on behalf of someone else.
Great. And I'm sure that will engender a whole bunch more questions as we go along. Well, another question that's come up a lot is what's the documentation that's going to be required? Luke mentioned payroll reports, send in new versions of those, even if you sent it to the same lender 9 months ago. As it relates to the 25% decline, you're going to need to be able to show either quarterly financial statements or an annual financial statement that shows a 25% decline, one or the other, unless your loan amount is going to be under $150,000. If you're in that category, you simply need to certify on the loan application. You're going to need to demonstrate it at some point, but you don't have to in order to get the loan. You'll have to before you file for forgiveness at some point between receiving the loan and filing for forgiveness.
Yeah, but I
Probably
wouldn't guess.
easiest just to do it all up front at once, because you're going to have
Yeah.
to show it to them at some point.
Yep.
All right. And then the fourth question, Jen, around second draw loans. This comes up a lot. If I'm taking a second draw, obviously I had a first draw. Is the SBA going to look at the combined value? And if it's over $2 million between the first and second draw, is that going to kick you into the economic necessity Form 3509 land?
Because I'm so stung by how diligent these audits are, these 3509 audits, when you don't answer them upfront and well and they come back, they're rough. So I'm afraid to say, don't be ready for this. I like to tell people who are filling out these forms, when you guys are asking us about numbers and what counts, I would say that probably the most important thing for you to read is the attestation section of the application. Don't just initial down that row, because it doesn't matter if they come back and they ask you for the 3509 if you truly did have economic necessity. So I'm telling people, be ready for it. If they had 1.1 million and they're going to get 1.1 million, be ready to have to certify need. They haven't said they won't audit people less than 2 million. They've just said they might not. So I'm afraid to say no.
Right. And well, any reviews that they are doing reviews under 2 million, but they're more like IRS audits. They're just sampling those. The over 2 millions, they are doing pretty much on a 100% basis. One thing to take some solace in that, though, that what Jen was just talking about is if you're getting a second draw loan, it's because you had a 25% or more decline year over year at some point during the year. That pretty much says I needed the money. I mean, my business obviously was impacted. So I would agree with Jen that what we don't know is still awaiting further guidance, but there is at least some reason to be confident in your justification for the loan because you qualified for that second loan.
Mm-hmm.
Okay, so there's a whole lot of challenges around all of this stuff. I do want to let you know that we have an entire team that is helping people do both loan and forgiveness application preparation for these new loans. They've been doing it for biggest end of a year now. All you have to do, we try to make it as simple as possible. We'll send you a set of documentation requests. You pull the reports, send them to us. We'll take care of it all and send you back what you need to sign, and we'll take care of it with your lender. If you want details around that, you can see the landing page there on our website. It's learn.armaninollp.com/SBA. And if you say that's cool, appreciate it, but really I'm just looking for a lender. I don't feel like moving all my banking business, but I just need a loan here. Luke's company is going to be all set up for that. Their web address is what you see here, acapgp4group.com. Okay, so one last thing, we've got hundreds literally of questions in our searchable FAQ library. If you wanted to try to learn everything you want to know about forgiveness, and soon to be updated with things around 2.0, which you can see here at this web address. And again, everybody will get a copy of this. It'll be posted, so you'll be able to very easily reference that. Jen, let's dive in on employee retention credit with the 25 minutes or so we've got left.
Okay. All right. The employee retention credit, the big news here, just absorb this, is that last year the ERC was not allowed to you if you took a PPP loan. They were mutually exclusive, but now you can do both. And this is a very lucrative credit if you do qualify for it. In the broad strokes, this is a credit that is to reward you if you continued to pay your staff, even though you were suffering. And by suffering, that means your receipts fell. Again, we're talking about gross receipts definition, which everybody's asking me what that is, and we're going to have to talk about reading the code here. But you can either suffer if your receipts drop or if you're continuing to pay people instead of laying them off, and they are really not able to work because of a government shutdown order. So I'm going to go through some decision trees on this. When you calculate this credit for 2020 and 2021, there are two amounts. For 2020, the maximum amount is $5,000 per person on your staff. For 2021, the maximum amount is $7,000 per person per quarter. So hear me, that's 5,000 bucks ahead last year and 14,000 bucks ahead this year, which is why people are really paying attention to this credit. Again, we have to really talk about how you would qualify for it, but those amounts are worth learning about this. The credit, once you calculate it, you go back to your quarterly payroll tax returns, which is no fun, but you go back and you file an amendment, 941X, and you put that credit on your tax return. It's refundable, which means that you go back and say you paid $100,000 in payroll taxes and this credit is $200,000, you get a $100,000 check back. And these credits are big. $7,000 per quarter for the first half of this year is a total of $14,000 for this year. We're not there yet. We don't know who's going to qualify in second quarter, so we're really focused on first quarter at the moment. All right, let's go forward because it's very complex. Bear with me. So to confirm, an eligible employer is either under government orders that are interruptive. So if the government quarantine, shutdown, shelter in place was disruptive to your business, and we have to document that in a variety of ways, that's one way to qualify during the period of the shutdown. So you have to look at the shutdown orders, and it has to be very specific times and dates. You have to get the mayoral orders. Or you could have suffered in 2020 a reduction in gross receipts quarter on quarter by 50%. And you have to compare 2020 to 2019. That's a pretty tough way to qualify. This year, in 2019, you still compare your base quarter to 2020, you compare to 2019. That's meant to be helpful. If you're down versus 2019, you're really down. It should be pretty easy. In 2021, we've got a lot of stuff on the web on our site on this. In 2021, your gross receipts only have to drop 20%. So that could be an achievable standard. There's a couple clues here. If your business is essential, it's hard to get this credit because the argument is if you're essential, you were allowed to keep working. You were allowed to do commerce. It would, you're somebody who probably had a heyday last year. Some of these essential businesses really went off. They did very well and everybody was more than busy. So that's a little bit tough. Now here's another thing. I think I have it on a different slide. In 2020, there was also an employee cutoff. So say you qualified because your gross receipts fell or because the government order was shut down. You were just really troubled by that. The next layer that we go to is how many people did you have? And the base year is 2019. If you had less than 100 people in 2019, you get to apply the credit to everyone on your staff. Everyone.
Wait, hold on. So if I only had let's say I've got 80 employees and 4 of them I had to say, I don't have anything for you to do. but I'll keep paying you. And the other 76 I kept on board, I get to get $5,000 times all 80. Is that what you're saying?
Yes.
Wow.
Now,
That's $400,000.
I'm kind of oversimplifying it because everybody's mind gets blown about now, but the credit is up to $5,000 per head. Let's start there. It's actually defined as 50% of the wages that I pay you, John, up to 10,000, which is a silly way of saying $5,000. Okay.
Right. To
But
anybody
if
that
you're
was paid at least $40,000 a year.
right. So, but say that it's just March 13th that I paid you and these 4 other people through maybe the end of March, and then I let you go. I don't get the credit again unless I paid you. It's against paid wages. But for that period of the 13th to the 31st of March, where your PPP wasn't there yet, during that time, if 4 people were paid, but they really weren't able to work because of the shutdown order, I get to take half of your wages up to 5,000 a head for everyone on your team because you had less than 100 people in 2019.
Wow.
It's a really huge, meaningful credit for small businesses. Okay. You can't really have PPP overlap. If I've got PPP money to pay you, obviously I was paying you, so I can't get the ERC. So you have to make sure you're defining a period of time that that company was affected by the orders. I can't take it for the whole quarter unless I have that significant decline in receipts quarter on quarter. In that scenario, I can take the credit for everyone on my team for the whole quarter because the whole quarter was a shambles, and I'm taking the credit based on my gross receipts, not on the shutdown. So your first eligibility thing is, am I shut down and is it messing me up? Are people not able to do their jobs? The other criteria is, are my receipts just horrible? And we only know about our gross receipts tumbling that much after the end of the quarter. So you end up having to go back and revise your payroll returns, but it's well worth it.
And
All right.
does wages just mean, earned pay, or can that be things like health insurance that maybe I paid for furloughed employees and things like that?
You can include its paid wages and health insurance, but it's not, say I paid you PTO that you'd accrued in a prior period. That doesn't count. It has to be this money that I paid you during this period of time that you earned in this period of time, and in some cases that you actually were not even working. Okay. This is
Great.
definitely too much to cover in less than 3 hours. So we're trying to hit the tip of the iceberg.
Yeah. And we will be diving into details on this as well.
Yes. So based on this conversation we're having, the work papers are really important here. You need to have a work paper that shows, after you've ascertained that you're eligible at the organizational level, you have to have work papers that show your payroll and show that you've carved out the PPP stuff, and what you're left with is wages that you still are eligible for credits on, and you have to identify the time period. So the ERC is supposed to take precedence over the PPP. So if you're eligible for the ERC, this is a really tricky thing. If you've already submitted your PPP forgiveness, it's like, what do I do now? I've already used second quarter to get my PPP forgiveness. I can't go back and get the ERC. The legislation says the ERC takes precedence. So you'd have to find some mechanism to redo your PPP forgiveness. I don't know the answer to that yet. We're waiting for FAQs on the Treasury site. The ERC was complicated enough before all this new stuff. It's all good new stuff. It's friendly to taxpayers, but it's complicated. The first time they issued it, it was already so complicated. They had 90 FAQs for this on the Treasury site, which we use a lot when we're looking at this. So this is a very careful plotting process. And there's a lot of work to it. But what we're seeing is that the credits are in the hundreds of thousands of dollars. So it's worth doing. It's worth getting guidance. Okay, so I tipped to 2 slides now. I'm going back to summarize this now that I've blown everybody's minds. I have a slide for 2020 here, and I have a slide for 2021. So in 2020, here's your flow chart. Did you experience either a 50% drop and or disruptive government orders? That's
and does
really
that have to be all quarters in 2020 or just any quarter?
Can be from March 12th forward.
Any
this
quarter.
is when it starts. Okay. Yeah, March 12th is technically part of Q1, but they're throwing it in with Q2 when it comes to doing the tax credits. Okay. I would argue that most people were disrupted at some point. On March 13th, I myself was a mess. So I think that we need to look at it that way. In that early March period, really look back, look at your emails, see what was happening. So if you, it's one or the other. It's not and, it's one or the other. There are two ways to qualify. So on this flow chart, which you'll all get, you'll see that if you answered yes to A, you had a 50% drop in receipts, you qualify. Bing, bang, boom. If, however, you qualify based on a disruptive government order that interrupted your business in some way, that has to be documented. You have to find the government orders and document that. And then what you have to do is think about like documenting who wasn't able to work, whether you have enough workers, whether you had 100 workers or not, and you have to do a lot of head counting. But it's not rough. That part actually isn't too tough. The 100 workers is based again on 2019. The law, John, you and I talked about this, the law says full-time workers in 2019. And so we'll answer that in the FAQs because we have an interpretation of that that's a little more specific than the law. Okay, let's go to 2021. The difference here, big difference is it's a 20% drop in receipts. That's a big difference. Again, you have the government orders. And the big thing here is 500 people is the cutoff. So in your example, John, when you said, what if I have 80 people and do I get it for everyone? My answer to you on this is in 2021, if you have 450 workers and your gross receipts drop 20%, you can get the credit for all the people on your team, 500. So for small employers, this is really helpful, especially if you're suffering, especially if the government has screwed you up with shutdown orders, or if, and it's not that you chose to comply, by the way. If, restaurants have been told they absolutely have to change the way that they operate. But if you chose to operate and you were actually an essential business, but you chose to be disrupted, you're not going to qualify unless you have the gross receipts test satisfied, okay? Let's keep going.
All right. There's been several questions coming in, but let me just hit a few of these with you. First one, how do I determine my base head count is under 500 or 100? That whole full-time employees thing, what does that mean?
All right, we've gone round about this. So the way that we are interpreting this is full-time equivalent. And the full-time equivalent is based on a 30-hour work week, because in the ERC instructions, they refer to a section of the labor code and the treasury codes, both that define a full-time worker as a 30-hour-a-week worker. But I would not go so far as to say if you have 20 full-timers and 80 part-timers, that you should say you have 20. We would go further with that and take all the part-timers and aggregate them into chunks of 30 hours to see what your full-time equivalent head count is. That's the way we would approach it. We do work
the more
papers.
Conservative approach.
Yeah, it's a little more conservative.
Harder for them to argue with anyway.
Yeah, definitely.
Yeah. Okay. Second question, government shutdown order. What does that mean? Where do I find it?
Could be a local ordinance from your mayor, could be from the governor, could be from the county. We've used any number of those combinations, but there is usually very specific wording about who has to do what in a curfew or shutdown situation.
Excellent. Thank you. Hey, here it is. Gross receipts as it pertains not to PPP, but to ERC. Is there a difference?
There really isn't much of a difference. However, I will confess that I go back and I read the instructions every single time we're with someone on this credit. If it's a nonprofit, I review it again. I go back and forth for both the PPP and the ERC. They have been legislated in the same law, so you can safely assume they're very similar. But the FAQs change them later, okay?
Yeah, well, then there's that.
Yeah, and you have affiliation rules to consider too here with gross receipts and head count both. It's worth reviewing that too, because if you're in gross receipts, you have a common management, common control group. It's all one gang. Same thing with head count.
Yep. Yep, exactly. So everything we're telling you is accurate until they change it,
Yeah.
which is pretty much guaranteed. You mentioned that you can't use payroll that you used for PPP forgiveness to qualify for ERC. How do I separate the two?
Right. This is really important. And those of you who have no revenue, I see people writing in who have no revenue or like, how do I get this credit? Or this is a payroll tax credit. This is not an income tax credit. So this is why nonprofits, this is working for them. This is a payroll tax credit. So what you have to do is look at payroll registers, and you have to do work papers and say, this chunk of people I used for my PPP forgiveness. This chunk of people are left over. I paid all of them, but I qualify their wages based on my eligibility. The only way to do it is with work papers. I would not, I'm going to say this out loud very many times over and over, don't use your payroll company's reports and just go, yeah, I tagged these hours with the code. This is a very significant credit. It's material. You need work papers and you need to document your eligibility. You cannot just print out a payroll company report.
Well, that answers the fifth question, I think. Can I just have my payroll company do this thing for me?
Yes. People ask me all the time, and the answer is no. If you want to do that, go ahead, but you're opening the door to a lot of problems because the payroll company isn't verifying your eligibility. They're not doing the work that it takes.
Right. All right. This is obviously very complicated, and because it's large dollars, it's likely to be subject to much greater scrutiny than most things normally. One other question that came in on the chat relates to the first question around headcount. Do the affiliation rules apply here in ERC like it does in PPP?
Yes. And again,
Okay.
I'm going to say, this is one law. These programs are both there. They're very consistent. And then what happens is they start releasing FAQs. And that's where the trail gets a little murky. And so you have to start with the law, and then you have to go to the FAQs to answer the questions. It's not a whiz bang answer, I know.
Excellent. And we will be gathering as many of the questions that we can't get to and putting it into our FAQ library here in the coming days, and diving into aspects of both the ERC program and the PPP program in quite a bit of depth in additional brief videos here coming up in the next week as well. Jen, we got a couple of minutes left. I think would be really helpful for people if you could do a quick case study or two, just to help people understand how this works and how the math gets big in a hurry.
Right. Okay. So both these programs are about wages. You don't remember this. You only qualify if you have wages to pay. I know that there are others. You can spend 40% of your PPP on other stuff, but I want to stress that because people are also now trying to get tricky with using PPP for other stuff. They're both wages. Okay. The ERC is for when you have less than 100 people last year, less than 100 people. On the two case studies on the left, let's just go straight to the money. This company on the left had 40 staff. They got a $180,000 tax credit in the end, and it's still growing. We're adding health insurance. The company in the middle was a nonprofit. They got a $75,000 credit or more. When I wrote this, we weren't quite done with it. What's happening is both of them are non-essential, so therefore they were impacted by government orders to shut down. The person on the left had 40 people. If you have less than 100, all your wages are eligible. So we documented that they were a cosmetic company. They were not essential. They had to send people home. They kept paying people. They were eligible. All the wages that they paid people and their health insurance premiums were eligible. The not-for-profit is an important point, again, because nonprofits don't pay income tax. When you get a credit like this against payroll, it helps nonprofits. You have less than 20 people, all the wages were eligible.
And if
schools
you
qualify here.
If the credit is bigger than your actual tax, what happens then? Is it lost?
It gets paid to you in a check. It's the craziest thing ever. You get a check back from the government. It's kind of an amazing experience, okay? Gyms are a good example. schools that are open, but they kept paying their bus drivers, even though they're essential. What's kind of fun here is you can carve out a section of your population that was non-essential. So it bears saying that if you can document the fact that you had this population of people at the school who are not teachers and you kept paying them, yes, you have a section that's non-essential. You could qualify.
That's fantastic. How about a big one?
Yeah, the big ones are in the hundreds and hundreds of thousands of dollars. We even have one client that got a $1.2 million credit. The one on the right is a great example. This is a telecommunications company. They have over 3,500 people. They are essential. I mean, we're all telecommuting right now, aren't we? It's essential. But they had a group of people who were in the laboratory who could not go to the laboratory and do their job. So those people were carved out. We documented that they were non-essential and that we had paid them wages, even though they couldn't do their job. We documented that in work papers.
And they got a $500,000 tax credit.
Uh-huh.
Yeah, that's definitely better than a kick in the head, isn't it?
Yes.
Yeah. Okay. So I know you've got a couple of flow charts in here. What do you want to say
No,
about
let's
those
just
in
go
our
through
last
those
10
because
minutes?
people are going to have to think about this. People need to stew on this. This flow chart is just to help you make a decision if you're 2020. The next sheet is 2021 so that you can look at it. And then you can also look at the slide where I have sort of the decision tree in words, depending on if you're a visual person or a reading person. I tried to make it so that when you're looking at this, you have a way to figure out if you could qualify for it.
Awesome. So all this is going to be in the deck. Everybody will be able to receive and revisit this webinar either via the deck or it will be posted on the Armanino website. And as I mentioned a couple of times, we have coming attractions starting next week on our website. We will be doing in-depth dives on aspects of each of these. There'll be 5 to 7 minute videos that you can reference at your leisure. They'll be going up probably starting Tuesday or Wednesday. And we'll dive into some of the details around these things and try to answer as many questions as we can as we go through that. And of course, if you do have any additional questions beyond those that you've chatted to us that will go into our FAQ library, you can certainly revisit the FAQ library. That's all searchable, or you can simply connect with our team at experts@armaninollp.com. Or of course, for any kind of information, and there are literally hundreds of articles and blogs that are up on our COVID-19 Resource Center. You can find that on our website at armaninollp.com/COVID-19. Basically the first thing you can click on. So with that, we are at the bottom of the hour. We thank all of you for your participation. Jen, thank you so much. Luke has already left us, but thank you as well to Luke for joining us. We know this was fast. We know it was hitting a lot of topics, but we appreciate your attention and encourage you to look forward to additional information as we put it out next week in more detail. Till then, have a wonderful weekend, everybody. Thank you so much.